Welcome back to Tech Monetize Official. Sarah here. Today, we're exposing a costly mistake in your investment portfolio dividend traps. Dividend stocks promise passive income, but not all are created equal. Some high-yield favorites are actually ticking time bombs, luring you in, then slashing payouts and tanking your portfolio. That tempting 7% or 8% yield? It often hides debt, declining business, or unsustainable payouts. Today, I'll reveal 3 dividend traps you must avoid, and 3 rock-solid alternatives with growing, reliable dividends. This could change your financial future, so stick around. Smash that subscribe button if you haven't already. It's free and helps the channel. Let's dive in. First up, let's talk about a classic dividend trap, ATTT, ticker symbol T, a company that once seemed like a no-brainer for income investors. For years, AT&DT was seen as a safe, high-yield stock. Its big dividends attracted investors looking for steady income, but those payouts were hiding deeper problems within the business. That high yield? It wasn't a reward for shareholders, it was a warning sign flashing bright red. The yield kept rising because the stock price kept falling, reflecting the market's growing lack of faith in ATTT's future. ATTT's massive debt, racked up from failed acquisitions like DirecTV and Time Warner, left the company struggling to innovate or grow. These deals were supposed to transform the business, but instead, they weighed it down. Instead of investing in its core business or new technology, AT&DT was forced to focus on servicing its enormous debt, stalling any real progress and limiting its options. The promised synergies from those big deals never materialized. In 2021, after spinning off Warner Media, AT&DT slashed its dividend by nearly 50%, shocking investors who had counted on that income. Investors who bought in for the income saw not just their payouts, but also the value of their shares plummet. Many were left disappointed and frustrated. AT&DT had been paying out more than it earned, funding those generous dividends with borrowed money, a recipe for disaster that couldn't last. The management team responsible for these decisions is gone, but the damage they caused remains, haunting the company and its shareholders. Even now, a seemingly decent yield can't erase years of broken promises, lost trust, and missed opportunities for growth. The lesson here is clear. A high yield often signals high risk, not high reward. Always check the company's debt levels and payout ratio. If the payout ratio is over 100%, that means the company is paying out more than it earns. Time to run, not walk away. Don't be fooled by a big dividend number. Look for companies with sustainable, growing dividends backed by real earnings and a healthy balance sheet. AT&DT is a textbook example of a yield trap, one that investors should avoid if they want to protect their capital. There are safer, better places for your money. Think diversified portfolios and companies with strong fundamentals. Remember, trust is everything in dividend investing. A company's track record and transparency matter just as much as the numbers. Always dig deeper than the yield headline. Do your homework before you invest. Don't let a high number blind you to the risks beneath the surface. Learn from AT&DT's mistakes and protect your portfolio. Move on to stronger, more reliable opportunities for your future. Next, let's talk about IBM, ticker IBM. Once known as Big Blue, IBM was a titan of the tech world, a company that helped shape the entire industry. IBM's dividend aristocrat status looks impressive, and on paper, it seems like a safe, reliable choice for income investors. But the business has stagnated for years. While the rest of the tech sector evolved rapidly, IBM missed the boat on cloud and AI, leaving its revenue flat or even declining. Their big Red Hat acquisition and recent push into AI were supposed to spark a turnaround. But so far, they haven't delivered real sustainable growth. Instead, IBM props up its dividend with increasing debt and massive share buybacks, not genuine business expansion or innovation. Buybacks shrink the share count, making earnings per share look better on the surface. But the underlying business isn't actually improving. This kind of financial engineering can't last forever, and it's a risky way to maintain a dividend. When buybacks or access to cheap debt run out, dividend growth will stall. and the stock price could drop sharply, hurting investors. IBM's payout ratio is creeping up, leaving less and less for innovation, research, or future acquisitions that could drive real growth. You're trading away long-term growth potential for a slow, unsustainable dividend that's losing its value over time. In the fast-moving world of tech, that's a losing bet for any investor hoping to build wealth. Don't be fooled by IBM's past performance. Future returns look increasingly bleak as the company falls further behind. IBM's dividend is a mirage, not a solid foundation for your portfolio. There are far better tech dividend stocks out there, companies with real growth, innovation, and staying power. Don't settle for a melting ice cube that's shrinking every year. Look for real growth, not just a payout. Move on from IBM and invest where your money can actually grow. The third trap, ExxonMobil, ticker XOM. Once a dividend staple, Exxon now faces existential threats from the global shift to clean energy. Unlike peers investing in renewables, Exxon is doubling down on oil, a risky long-term bet. Oil prices are volatile, making Exxon's dividend unpredictable. In downturns, Exxon borrows to pay dividends, never a good sign. A safe dividend should come from cash flow, not debt. Your income depends on oil prices, geopolitics, and economic cycles, none of which you control. Institutional investors are divesting for ESG reasons, adding more pressure. Activist investors are forcing change, but uncertainty remains. Today's yield looks attractive, but the risks are mounting. Exxon is in a structurally declining industry. Don't mistake size for safety. There are more stable, future-proof dividend options. Don't gamble your retirement on oil's next move. Look elsewhere for reliable income. Now, let's talk about what you actually buy when you invest in a true blue chip. Starting with Microsoft, ticker MSFT. Microsoft isn't just a tech giant. It's a dividend growth powerhouse that has consistently rewarded shareholders for decades. The company's dividend is backed by a diverse mix of fast-growing businesses: cloud, Azure, software, Office Windows, gaming, Xbox, LinkedIn, and cutting-edge AI. This diversity means Microsoft isn't reliant on any single segment, making its cash flows more resilient and its dividends safer. Subscription models like Microsoft 365 and Azure create stable, recurring cash flow that supports both innovation and reliable payouts. Microsoft's yield may look modest at first glance, but its dividend growth is exceptional. About 10% per year for a decade, compounding your returns over time. The payout ratio is low, leaving plenty of room for reinvestment, future increases, and weathering economic storms. This creates a virtuous cycle. Business growth fuels dividend growth, and rising dividends attract more investors, driving further growth. Don't chase high yields. Focus on total return and dividend growth, which are the real keys to long-term wealth. Microsoft offers both capital appreciation and rising income, giving you the best of both worlds as an investor. Would you rather have a risky $8 yield that could be cut at any time, or a $1 yield that grows every single year, compounding your wealth? Microsoft's fortress balance sheet and leadership in tech trends make its dividend among the safest and most reliable in the market. It's the gold standard for long-term dividend investors, setting the benchmark for quality and consistency. Shift your mindset. Growth plus income beats yield alone. Microsoft rewards patient shareholders who think long-term. Build your portfolio on this kind of foundation. Don't settle for less when you can own the best. Microsoft is where you want to be for lasting growth, income, and peace of mind. Next up, Procter & Gamble, ticker PG, the definition of stability. P&G owns iconic brands you use daily: Tide, Crest, Pampers, Gillette. These essentials sell in any economy, making PG's business resilient and predictable. P&G is a dividend king, raising payouts for over 67 years through every crisis. Unlike IBM, PG's dividend growth comes from real business strength, not financial tricks. Their healthy payout ratio balances shareholder returns with reinvestment. Don't expect explosive growth, but do expect steady, reliable income. P&G anchors your portfolio, smoothing out volatility when markets crash. People always need their products, recession or not. This defensive quality is invaluable for long-term investors. PG's track record is unmatched for reliability. It's the cornerstone of a safe dividend portfolio. Choose stability over speculation. For true passive income, P&G delivers. Let it be your portfolio's bedrock. Sleep well at night with P&G. Finally, Johnson & Johnson, ticker JNJ, a healthcare giant and dividend king. J&J's strength comes from its focus on high-growth pharmaceuticals and medical devices after spinning off its slower consumer division. Healthcare demand is rising with an aging population, putting J&J at the center of a long-term growth trend. Their balance sheet is rock solid, with low debt and massive cash flow. This financial strength funds a safe, growing dividend, over 60 years of increases. J&J invests heavily in R&D and acquisitions, ensuring future growth. Risks exist, litigation, patent cliffs, but JJ's size and diversification help manage them. You're not betting on commodities or declining industries. You're investing in essential human health. JJ's dividend is built to last generations. For stability and growth, it's one of the best choices. Don't settle for shaky dividends. Choose enduring strength. J&J is a foundation for any dividend portfolio. Invest with confidence. To recap, avoid dividend traps like AT&T, IBM, and ExxonMobil, high yields, shaky foundations, and big risks. Instead, focus on quality and dividend growth with Microsoft, Procter, and Gamble, and Johnson & Johnson. These companies lead their industries and grow both their businesses and dividends year after year. That's how you build lasting wealth. Capital appreciation plus rising income. Look past the shiny yield. Dig into business health. If you found this helpful, subscribe for more insights. Share your favorite dividend stocks or traps in the comments. I read them all. Thanks for watching. See you next time.